Hello and welcome, everyone. My name is Devin DeCiantis, and I'm the managing partner at LGA. I'm very excited to welcome you to our inaugural LGA Insights webinar for a variety of reasons. First, it's an opportunity to introduce my friend and colleague, Dimitris Valatsas, to all of you. Dimitris is our new resident macroeconomist and comes to LGA with a long history of working with enterprising families to manage and mitigate risk in both their operating and their investing portfolios. And you can find his impressive bio on our website, but basically, you couldn't ask for a better guide to understanding what's happening in the financial markets today and where we're headed next. Second, as fractures in the banking system begin to emerge earlier this year, we've been asked by countless families around the world what's likely to happen next and how it might affect them. So we decided to use this topic to launch our new LGA Insights webinar series, because we believe that all families should have access to this type of risk intelligence, both the data and the frameworks to help them make better decisions about the future. And we really thought this medium was a great way to share these insights both quickly and broadly. Third, while many members of our global team have been invited to participate in countless webinars before and during the pandemic, of course, this is the first event we're hosting in-house. And while we couldn't be more excited, as you all know, attending a party is very different from hosting one. So please bear with us as we experiment with this new medium. Now, before we dive in, I just want to share a few brief words on logistics. Just so everybody is clear, we're recording this entire session so you can watch it again in case you missed anything, wanted to review anything, and of course, for the benefit of those not able to attend live with us here today. And we'll also end on time in a little under an hour. You're all very busy professionals, and we appreciate you sharing your finite bandwidth with us, of course. Once we open up the session to Q&A about halfway through, there will be two ways to ask questions. You can use the raised hand button that we're probably all familiar with at this point in Zoom and ask the question verbally, or you can use the Q&A button at the bottom of your screen to type in your question. And this latter option will also allow you to ask a question anonymously if you'd prefer. And you can also type those questions in throughout the presentation. They will accumulate and we'll get to them during the Q&A portion. So feel free to use that functionality liberally. After the webinar, you'll each receive an email with the recording, and a very short survey about what you liked and what we could improve for future webinars. You'll also have the opportunity to connect with Dimitris directly to request a copy of the slides for your future reference or to share with others. And finally, before we get started, I've been asked to remind everybody that the information presented in this webinar is for general educational purposes only and does not constitute professional financial advice. Now, that's it for logistics. So without further ado, Dim, let's dive into the session.
All right. Thank you, Devin, and good morning, everyone. In fact, it's great to be joining this new venture with LGA Risk Insights and to have everyone with us. We'll start by handing it back to Devin so he can give us a little bit of an overview of how the LGA approach to risk management for families is designed. And then I'll take it right back and walk you through the banking crisis we are currently going through. Devin.
Thank you, Tim. This particular topic is of great interest to me personally, as I've been writing about and advising and teaching families about risk for over a decade now. And over that time, we've developed a framework here at LGA for strategic risk planning that will help to set up today's conversation and provide you with a little bit of context for how we think about the issues that Dimitris will be walking us through today. One of the things that we've noticed over the years is that there are many risk models and frameworks out there that are either so granular that they become overwhelming or so superficial that they don't capture the full dynamics of a family enterprise system. And so we like to think of managing risk as happening in sort of three concentric circles: an inner circle, what we call internal or proprietary risk. And these are risks over which families mostly have full control. They are decisions ultimately made by the family about their own family enterprise, either their operating assets, their investable assets, or both. There's another veneer of risk that sits outside of that internal circle that we'll call interactive or shared risks. And these are risks over which families have some influence, but over which they do not have exclusive control, and which can meaningfully shape performance outcomes and continuity outcomes for the system. And then finally, there's a veneer of external risk out there over which families have very little influence, but which can meaningfully disrupt operations and even be critical, mission critical in time. And that's where we're going to focus a lot of our effort today. Dimitris is going to walk us through a cluster of those external and interactive risks that families really ought to be attending to as we think about some of the dynamics playing out in the banking sector, both in the US and internationally here. And so I hope that this provides a little bit of context. And Dim, why don't you dive into the details here for everybody?
Perfect. Thank you, Devin. And we've highlighted here a few of the risks we'll be addressing: inflation, financial markets, economic growth, and public policy. And on the interactive side, infrastructure, which means financial infrastructure, the way a family enterprise interact with our bankers and the financial system, and how that's under threat by the banking crisis we're going through today. So a very brief chronology of the banking crisis of 2023 would naturally start with the failure of Silicon Valley Bank. One of the top 25 banks in the United States was with over $210 billion in assets. It's a very sizable bank. In most countries, it would be one of the largest banks in the economy. It was taken into FDIC receivership on March 10, 2023. And quite astonishingly, the rule book for protecting depositors was not followed in the way that it was foreseen in the regulation. Instead, the authorities declared SVB, the 16th largest bank in the United States, to be of systemic importance, and therefore warrant a special exemption from the rules so that all depositors would be protected up to the full value of their deposit. So this was an exception to the existing framework that in theory only protects the first $250,000 of deposits in an FDIC protected institution. 2 days later, it was clear that the country was entering a protracted banking crisis when Signature Bank, a bank in New York of about $110 billion in assets, failed. It was closed down by New York regulators and by the FDIC. Again, depositors were protected, but shareholders were wiped out. Internationally, the following week, behemoth Credit Suisse was at risk of failing. Obviously, this was a systemic risk for the Swiss economy and for the global economy as a whole. And the bank was forcibly sold to its main domestic competitor, UBS. Once again, depositors were protected. Shareholders were wiped out. Some bondholders were wiped out, and we can talk a little bit more about what that means for the global financial system. But all normal transactions that the bank was undertaking were protected and continue to be protected under this new umbrella organization, spearheaded by UBS and bankrolled, we should note, by the Swiss government and the Swiss National Bank. Finally, last week, and I was a little bit worried today that I would have to update the slide once more, but last week, First Republic, a major bank with $229 billion in assets, was essentially shut down by FDIC, then immediately sold to JP Morgan, which is the largest bank in the United States. Once again, the playbook was applied. Depositors were protected in full. Shareholders were wiped out. Subordinated debt and preferred stock was also wiped out. So I think what we're seeing here is this is not so much the kind of bailouts we were used to in 2008, where shareholders and bondholders were protected. This is depositor preference, pretty much irrespective of amount, even though not legally guaranteed, whereas investors, both bondholders and shareholders, face significant losses. So this is where we are today. Let's look a little bit back and think about whose fault this all is. I mean, there's clearly a systemic issue with the banking system. A lot of banks are failing. These are not small banks. These are not your community banks. People will refer to them as regional banks, but in reality, they're very large financial institutions. And some of the things that have emerged in the aftermath of the failure of these banks is that not all of them are managed like serious, large, multi-billion-dollar financial institutions. For example, Silicon Valley Bank did not have a chief risk officer for almost 8 months. The result of this is that the risk that brought down the bank, which was an inability to hedge duration risk, is one of the most basic elements of financial analysis. SVB was brought down not as in 2008 because of dodgy loans to people without jobs and income. It was not because of an overextended exposure to real estate or anything of the like. It was exposure to US Treasury bonds, the safest asset in the financial system, usually. The problem was that duration risk was not appropriately hedged, and some internal failings were to show there. And we'll talk a little bit about how it came to be that such a large organization could go on without adequate interest rate hedging, without adequate liquidity provisions, without adequate risk management. Obviously, depositors have been blamed because they were too quick to move their deposits instead of supporting their bank. SVB in particular, as the bank of the startup ecosystem in Silicon Valley, and many of the depositors have been blamed for kicking off a bank run on social media and other venues and moving large amounts of money from their portfolio companies en masse. But the reality is, once a bank run starts, the rational thing to do is to join it. Otherwise, you are left holding the proverbial bucket. So it's easy to blame people for not standing by their financial counterparty, but in reality, this is not something that policy or even moral pressure can ever fix. The rational thing to do will always be to join the bank run once it's started. Social media platforms also accelerated the flight of capital out of banks. One of the features of modern bank runs is that it doesn't even require a run to the bank. You can load up your banking app and remove your funds pretty much instantly. Now, in the old days, you had to go line up at the bank and they'd shut down a few windows and they try to slow down the process. SVB, interestingly, did that as well. There were a number of network outages on the Friday before the bank failed. But in reality, I think we've seen much higher velocity and people moving out of banks than we would have seen in the past. And that's partly because of technology. Again, that's not something that I think can be rolled back. Finally, and perhaps most crucially as to why this is happening on a global scale and across multiple banks, is monetary policy. Monetary policy kept rates for way too long at way too low levels, and is now hiking them extraordinarily quickly. Depending on your measurement, this is either the quickest or the second quickest hiking cycle in US history, which means all these financial dislocations occur very, very quickly in macroeconomic time. Now, I want to zoom a little bit on the policy because it is tempting to say this particular bank had this particular problem and this other bank had this other problem. But in reality, when we see bank runs that are so pervasive, some of the blame has to lie with the policymakers. And this is the chief policymaker responsible for, obviously, monetary policy in the United States. And I wanted to, I drew this, it's from the New Yorker magazine. This was, in the midst of the COVID pandemic when the Fed was, portrayed as doing an extraordinarily good job at managing the crisis. And I think a few things went unnoticed as to what the Fed was doing back then. Some of them on the monetary policy side, some of them on the regulatory side. Now, this is Chairman Jay Powell with Vice Chair for Supervision, Randall Quarles. And in 2019, before the pandemic, it was little noticed at the time, and people are digging it up today, but the Fed essentially loosened regulation on a particular category of banks under the banner of making it easier to do business. And the type of regulation that was loosened were things like liquidity provision, things like liquidity monitoring, regulatory oversight. And there was a particular bracket of banks that was targeted, and those were banks with between 100 and 250 billion in assets, so-called Category 4 banks. And by focusing on those smaller banks, there was a move to deregulation. At the time, Lyle Brainard, who was vice chair of the Fed until recently, issued a dissenting opinion saying, this is very problematic. We are deregulating. We are loosening our oversight of banks without having seen our rules play through a full cycle. And this will come back to bite us, essentially. And I think she turned out to be right. I think regulation was loosened too much for much of the banking system. And as a result, we see the banking failures that we have today. I think this explains to some degree why they have been concentrated, in this bucket. Remember, all three major banks that failed were in this particular bucket of loosened liquidity requirements and loosened regulation. And also why it has been concentrated here in the United States as opposed to globally. And that is one component, the supervision component. But there's a second component, which is monetary policy. As I mentioned before, SVB had loaded up on US Treasuries, very safe assets, so long as interest rates do not move very, very quickly, which is what happened during this period. So we entered a period after the COVID crisis in which interest rates were near zero. 10-year Treasuries were yielding 0.8 to 1%, historically low numbers, which forced the banks to load up on more and more Treasuries further and further out the yield curve. And by the way, this was not just banks' treasury operations doing that. This was also the policymakers saying, these are the safe assets you need to load up on, because when we do your stress tests, these are 0% risk-weighted assets. We're not going to take duration risk really into account. Our severe scenarios all foresee that these assets will rise in value in times of stress, not fall, as happened during this period. And I don't think the policymakers have really adjusted their tune yet. This is from the FOMC statement yesterday, which included the words, the US banking system is sound and resilient. Anytime a monetary policy announcement has to include warning signs like this, I think is a very good time to worry. There has been no adjustment to monetary policy as a result of the bank failures. In fact, the Fed hiked rates yesterday in the policy announcement that included this sentence. So, the consequences of that, I think, is that we are likely to see more of these bank failures. We are likely to see that mismatch between liabilities and assets play out over the rest of the financial system and affect the economy as a whole, affect businesses, affect enterprising families, and affect families across the United States and globally. So what we wanted to do at this seminar is bring all these things together, bring all these insights from our research together, and come up with some actionable insights for you folks. So we can see, what can you do to prepare? What can people do to prepare in case this banking crisis continues? So first, I'm going to take a step back and focus on some of the conclusions. First of all, this is not small bank failures. $550 billion, which is all the assets that have been moved around by the three bank failures in the United States, that's a lot of money to be shuffled around so quickly. And Credit Suisse, obviously, is about a similar amount in just one financial institution that had to be moved overnight. This is historically unprecedented, other than for the global financial crisis, to be moving around so much money so quickly. What regulators have shown is that there is zero tolerance for deposit losses. And at the same time, that has not been put down into law. There is no guarantee that FDIC will protect over $250,000 of deposits going forward for every institution. It is possible that that will change, but it will require congressional approval, which is something that's very difficult these days. However, unlike the financial crisis, there is much higher tolerance for wiping out shareholders and junior credit. And I think that's particularly important for family offices and family asset managers that it's a very popular products. They had quite substantial yield, especially those additional tier one products that Credit Suisse wiped out. So it's important to note that there is no implicit bailout of any of these shareholders, preferred equity holders, or additional AT1 credit holders, and we can expect that to continue. Again, it's admittedly a little bizarre. The problem is so concentrated in the US banks. US central bank has raised rates faster, but not that much faster than other banks. And I would say European banks in particular have been exposed to zero or negative rates for a very long period. So I'd be on the lookout, not just in the United States, but in other jurisdictions as well. It's a very unusual period of very quick monetary policy tightening, and we should expect to see frictions in the financial system elsewhere as well. It is clearly not a coincidence that banks where regulation was loosened the most were the ones that failed. And I think that's been recognized by the Fed as well. And finally, the fundamental problem of all this is that over the past, reality decade and a half, banks have been required to invest in products that earn 3%, 3.5% at best. And now they have to finance this with deposits that are costing more and more. After the failure of SVB, it is common for banks to be offering 4, 4.5%, 5% to attract deposits. So this is a fundamental mismatch in their banking model. The classic maturity transformation operation that a bank does, takes short-term deposits, converts them to long-term yielding assets, has become problematic, is not profitable. And my expectation is that will cause the Fed to pause hiking in June, potentially cut rates later in the year to be able to restore profitability in the banking system. Otherwise, this is kind of a continuing ongoing problem for the banking sector, not just in the United States, but everywhere where rates have risen very quickly. So liabilities become more expensive for banks, while on the asset side, interest rates can be to a large extent fixed. So this is the conundrum that's being faced by everyone. I think it's very important to prepare now, if you haven't already, for a very turbulent period in financial markets. Now, Devin, I'm going to pause there. Maybe, I don't know if you want to run one of our polls for our participants. Otherwise, very happy to jump straight into our actionable insights, which is our thoughts on what enterprising families can do to prepare for the financial turbulence that we are living through today.
Thanks, Dimitris. This is a terrific start. I don't see any questions in the Q&A section of the Zoom here. So if anybody has any, please chime in. Dimitris, which of these poll questions should we jump into here first? Let's just try to get some interaction from the group, maybe about the timing of the next banking crisis. Here we go. So folks, all right, so online here, go ahead, Dim.
So this is a poll on the next bank failure and where it's likely to take place. I think it's important to, again, realize that while this began in the US as in 2008, it has the potential to spread elsewhere. So we're very keen to get people's thoughts on where they think most of the risks are. And one of the things that I'm seeing, Devin, that's very interesting to me is that emerging markets seem reasonably well protected. And I think part of the reason is the financial products is not so much concentrated on fixed income. And also emerging markets started hiking well before developed markets. I'm thinking of Brazil in particular, that was well ahead of the hiking range. So I think it's a little bit of a consensus emerging among our participants that this is primarily a US problem. And it's a problem that is, has been focused here and is likely that the next major bank failure is going to be here. In fact, I'm sure the news tickers are going on in the background. There is a bank over 50 billion that is in acute trouble right now. So thank you very much for participating in the poll.
There are the results for everybody here. I think the group in attendance today shares your views, Dimitris, that the US seems to be the market most exposed here. We talked a little bit about the regulatory context here. We can get it into this in the Q&A, but I'm curious, is your take, and if we have to imagine Credit Suisse is sitting outside of the European Union's regulatory oversight in Switzerland as being an exception to the rule here, but do we feel that there is any exposure, for instance, in Germany or Italy or France, or of course, the financial institutions based in London? Is that something that is a risk that we are not yet fully attentive to, or do you feel that this is truly a US regulatory issue and is manifesting in this narrow portion of the broader financial system that you've appropriately pointed out was deregulated recently and is now feeling most of the pressure?
I think that's a great question. There's one thing that European banking institutions have going for them, that they have been in crisis mode for about 10 years. So regulators have been incredibly attentive to movements in capital, to where their assets sit. But it is it's well known among financial sectors that Italian banks, for example, hold an extraordinary amount of Italian treasury bonds that have sold off substantially over the past 3 years because of interest rates going up. So I definitely wouldn't feel safer or much safer in Europe the way the regulators portray it. There is higher regulatory oversight. There has been oversight for a very long while. The new centralized European supervisory authority is actually extremely competent, extremely good at what it does. That having been said, it's the same banking model. It holds roughly the same mix of assets, a lot of them in fixed long-term mortgages, for example. And that's not immune to the kind of problems we're seeing in the United States. So I definitely wouldn't be complacent in a European context.
Excellent. And we just did get a question in from Larry Rosen. Larry, thanks for chiming in here. He's asking about the Canadian banking system and whether or not that's at risk. And I know you and I have been playfully joking about this of late, but any insights or feedback for Larry and others who are curious about Canada's otherwise resilient financial institutions?
I think there are two key differences between the United States and the Canadian financial system. One is that Canadian system is generally less exposed to fixed rate risk in terms of mortgages resetting a lot more easily. And at the same time, from the payer side, that means that the population is much more exposed to interest rate hikes. The result of that is that the Bank of Canada can be a little bit more attentive and a little bit more careful. And I think we've seen that over the past year in how quickly they hike interest rates. However, again, it's the same banking model. There are a lot of secular trends going on. We'll talk a little bit about commercial real estate and how the need for that seems to have reduced in North America in particular, but the financing required for it has not reduced. So it's these types of mismatches that I'd be on the lookout for to think, hey, there might be an issue here. Is there enough? And again, it's not so much a question of capital, but is there enough liquidity? Should we be worried about people moving from one end to the next? Right. I think that's a fantastic question. Canada is a fascinating financial market.
The other thought, just a brief aside on the Canadian financial institutions that may be exposed, is that many of them have U.S. subsidiaries that are feeling some of the pinch here. And so there's questions as to whether or not that will eventually translate or cascade north of the border. But there are plenty of firewalls, as anybody who's tried to bank on either side of the border knows. They are truly independent institutions from one another. And so there are ways of compartmentalizing that risk. But Dim, let's hop into the actionable insights, and then we'll open it up to further Q&A. Thanks, Larry, for the question. Why don't we do that? And anybody else who wants to add some questions into that Q&A module, please line them up, and we'll get to them either throughout or towards the tail end of the session.
Fantastic. And now these actionable insights all come with a poll of their own. Again, to get a little bit interactive and get your guys' thoughts on what's going on. So I think one of the reminders, and this is important for every business, but for family businesses in particular, and we'll talk a little bit about why that's the case. It's very important to remember uninsured depositors, meaning in the United States, things over $250,000, in Europe, things over 100,000 euros, are essentially very senior unsecured creditors. It is a fallacy to think of money in the bank, again, above that threshold, as safe. It is not a safe asset. A safe asset is a very different thing to a bank deposit. The insured component is a safe asset. It's the same as a US bond. It is guaranteed by the full faith and credit of the US government in the United States and the local governments in the jurisdictions where the bank account is held. But an uninsured deposit is not a safe asset, not in the technical sense of the word, in which there's no creditor risk, or in any other sense of the word. So that's very important to remember. And it's also important to remember that there have been bank failures in the past 10 years, and I'm referring here to the Cypriot system failing in 2013, where depositors who held money over 100,000 euros lost almost half their money. And I think that's important to remember. Just because it's in the bank doesn't mean it's safe. And I think people have been learning that, unfortunately, well, the hard way in Cyprus. They haven't really learned that lesson yet, because the regulator stepped in so forcefully. But it's an important thing to remember, and an important bias that obviously banks rely on for their funding. But I think for users of bank deposits, it's important to keep that in mind. Just because it's in the bank it doesn't mean that it doesn't have credit risk. So that's insight number one, is to reset your thinking around treasury operations in this manner. And I see here, as part of the poll, that most people think it's either a marginal risk or a substantial risk that the banking crisis is posing to family enterprises and or businesses. And I think that's fair. Depending on your exposure, it can be a significant risk or it can be a marginal risk. I think we can move to the next. There we go. Now, lesson number two is it's better to be diversified, and it's not that hard to do. And Dev and I included here one of my favorite family businesses in the world. These are the Antetokounmpo brothers. All four of them are members of the Greek national basketball team. The most successful one, Giannis Antetokounmpo, who plays for the Milwaukee Bucks, really took the lesson to heart that money over 250K was not safe in his bank account. And the guy makes that in every game, right? So what he would do is he would open a different bank account with a different bank every time he crossed over the $250,000 threshold, which I think is very enterprising of him and a way to maintain family wealth. Now, in reality, you don't actually need to go to such extent. You don't need to be going to a different bank after every basketball game. But there are things like money market funds, right, that I think people are not attentive enough to. These can diversify your liquid holdings. They're extraordinarily liquid because they trade in liquid securities, but they can diversify your risk because the risk is not your broker, is not the operator of the fund. The risk lies with whatever underlies the fund. And in many cases, this can be US Treasury bills, for example, or Canadian bills, or whichever jurisdiction you are in. In other words, very liquid assets that diversify your credit risk regardless. And just as importantly, this can yield more than a bank account or even a certificate of deposit and give you higher liquidity. So I think it's a very important, again, obviously this is not financial or investment advice, but it's important to discuss these treasury options with your financial planner or advisor. You are not locked into your bank. And in general, your bank should be giving you options to park your money somewhere else other than their checking account. So I think this is very interesting. Poll results here roughly split halfway between we haven't changed anything in our portfolio operations or we have, which is very, very interesting to me. And finally, third insight, and again, I think this is particularly important for enterprising families, is don't bank all your eggs in one basket. One of the vulnerabilities that we've seen, and it came to me, during the SVB situation, where a family reached out to me and said, Tim, how is this going to play out? We have all the business assets in SVB and all the family assets and the mortgages and the kids' accounts and the savings accounts and the 529s and the IRAs. And because we really like them, the bank relationship manager is really good. So I think this is a particular risk that families should be very attentive to. Does your family bank where your business also banks? Does your family office also bank there? Do you have any balance sheet exposure or perhaps a line of credit that you are relying on for an expansion in your business that might be at risk, whether the bank fails or not? Do you diversify your cash holdings beyond that one financial institution, either within the family office or across different members of the family? And are you prepared to weather a credit contraction? I think these are important questions to be asking and to be sharing with all family members, because this is where concentration risk has the potential to become catastrophic. Thankfully for the family I was mentioning, SVB was essentially depositors were rescued in their entirety, but they faced a catastrophic event if that had not been the case, if the Treasury and the Fed had not declared a systemic exception. So I think this is something that we see every day. It's very important to prepare in advance to not be 100% reliant on any financial institution. And I think of our participants, I see here about 1/3 uses primarily one financial institution, and 2/3 use different financial institutions for different purposes. So maybe a well-diversified group here. So I think now is as good a time as ever to review risk exposures, financial and other counterparties, and examine exposure to external risk. And I'm going to close the poll right here and hand it back to Devin. And I think this is our time for, well, right before we jump to Q&A, maybe, Devin, we should go through a little bit of summary of conclusions, what's coming next. And I think it's possible, but far from certain. I think that First Republic will be the last bank to fail this cycle. I mean, it might not be the last bank to fail this week at the current rate. Other geographies are probably not immune. And we'll share these slides afterwards, so you can run back. And obviously, we're very happy to answer any questions. Interest rates, and this is my personal view, are probably too high to sustain financial stability. Will probably have to come down at some point later in the year. I think it's important to think that what happened to banks can also happen to shadow banks. Bank-like structures that do not have to mark to market. I'm thinking in particular of private equity and private credit here. I think people should be extra vigilant of these vehicles and really pressuring their managers for clarity, transparency, where those assets would lie if they had to be liquidated at some point, and what the implications are. This doesn't mean that the assets are not safe. It means that it might take a lot longer for them to hit the balance sheet than people were expecting. And finally, watch commercial real estate, and it's it's a highly financialized product. It's subject to adverse secular trends with work from home following COVID. So a very important thing to look out for, not just in the US, but also Canada, UK, Europe as well. And with that, I'm going to hand it back to Devin for Q&A, and then we can look at the overview as a concluding slide.
Excellent. Thank you so much, Dimitris. I want to kick things off with a couple of questions that have come in from the group here. And one is from our colleague, Fernanda Jaramillo, who is asking about the interest rates, which you've alluded to, and possibly the Fed taking a pause on raising them, assuming that they're reading the same tea leaves as everybody else at this point. It hasn't seemed to be the case necessarily over the last couple of weeks and months, but in particular with implications for Latin America. And as we begin to think about this, you alluded to the idea of emerging markets as escaping relatively unscathed from this first phase of the banking crisis. Also, you and I have been talking last week about this reserve position of many of these economies, which is unlike it was 10 plus years ago. It's almost as though they'd learned the lessons of crises past and have protected themselves appropriately for the ones to come. But any comments on Latin America in particular and its exposure to foreign exchange and other interest rate fluctuations?
Yeah, I think that's a great question. I mean, in general, macro emerging markets are just considered high beta investments, meaning the little volatility in the US can cause tremendous volatility in emerging markets. My contention would be that emerging markets, and in particular the big Latin American economies, Brazil and Mexico, through their monetary policy, have actually managed to front run a lot of these risks. They tightened policy early. They didn't spend as much money as the US did on many of the COVID-related expenditures, and they were able to keep monetary policy tight much earlier. So they weren't taken by surprise. In many ways, they led the Fed, and I think that's what we've seen with the performance of the Mexican currency in particular, which has remained extraordinarily strong. Now, obviously, in Latin America, there's many idiosyncratic stories where we have much weaker currencies. But I think for the major economies, the surprise has been to the upside, that they've actually been much more resilient. They prepared their economies earlier for the tightening cycle, and are therefore performing much better than you would have expected with such an unprecedented tightening cycle. I just note here that when we had the taper tantrum in 2013, which was minimal move in monetary policy compared to what we're seeing today, the repercussions were much more severe. So I think the policymakers have done a fantastic job, frankly, in both Mexico and Brazil, the major economies, to protect their currencies from the monetary cycle, less so in places like Colombia and Chile.
Fantastic. Thanks, Tim. One of the other risks beyond macroeconomic stability and foreign exchange and that outer external ring of risks that we talked about was the political context and public policy. And we've got a question here from Emilio, who's asking about the political uncertainty that exists in Latin America that is perhaps in contrast to their macroeconomic stability, and that one of the strategies for enterprising families who operate in those environments where volatility is in fact the norm is to get some assets into a safe haven, and the U.S. has conventionally been among those safe havens. To what extent, he's asking, do you think that this banking crisis affects that strategy?
I think that's a fantastic question, Emilio, and I think it should affect the strategy in the sense that it highlights some of the risks inherent, and not so much in the geography, but in the type of asset in which the safer assets are deployed. So I think a bank account is not the ideal destination for these sorts of assets. I think there are many other financial instruments that can give you the protection and security of the US legislative system and the rule of law and the strength of the US dollar without necessarily being exposed to a particular bank account or a particular bank. And US Treasuries obviously being the safest asset there is, although I do see a question on the debt ceiling, and we should go back to that. But I think generally look, don't just think, oh, I'm going to take my assets, go to the US, and then they're safe and they're done. Look at the underlying asset structure and what's in the kind of safe asset space that will best serve your needs. And again, this is a great discussion to have with a financial planner, not just how am I going to be in a safe jurisdiction? How am I going to be in safe assets within that jurisdiction?
And if I can just add, Dimitris, in terms of an operational strategy, oftentimes we perceive of certain markets as being safer than others, particularly those that are coming from or migrating assets or operations from riskier environments, emerging or frontier markets, and into more developed and mature ones. And while that perception of risk or the type of beta that Dimitris was talking about just now might be true, and that there is less volatility in general in those environments, migrating strategic planning into those contexts, migrating relationships into those contexts, changing the ways in which we conventionally do business can in fact be even riskier. And you don't need to look much further than folks, for instance, like Carlos Slim and his family, who at a time tried to migrate their Mexican operations, which were quite large and substantial throughout Latin America, north of the border into the US, and eventually got chased back because the operating environment was hostile to the deal making and the relationship-based entrepreneurship that was so successful for him and his operations in Mexico and beyond. And so we can't just think of these environments as exclusively being safe simply because the assets in those environments are less volatile or perceived of as having less inherent risk. Shifting into these environments comes with another attendant set of operational risks that families ought to consider as well. We'll save that for another webinar, as we've got a whole thing to say about that, and we're actually writing a book about it right now too. But thank you for the question, Emilio. Terrific. We've got a question here, Dim, on the bank that you've referred to that is close to collapse. In fact, there are a couple of them over these last several days that maybe we can highlight for the audience here today.
Again, I wouldn't want to precipitate a bank run in any way, but if you go to the front page of the Financial Times, you will see two institutions that have publicly stated that they are considering strategic options, which is their way of saying they're trying to sell themselves and rescue some shareholder value. Again, as I said, I don't think this will be the First Republic will be the last bank to fail or to be forcibly taken over. I think that's what we're seeing today, and we'll continue to see over the next days and weeks, unless there is more forceful intervention from the authorities. Thanks,
Tim. We have another question here, speaking of the authorities, and it's related to the debt ceiling, and Ms. Janet Yellen's recent remarks about the risks attendant to tripping and defaulting on U.S. debt and all of the longer term consequences. Nobel laureate Paul Krugman just earlier today revisited this idea of the $1 trillion coin and all sorts of other financial alchemy that might be used to avoid this if there isn't a congressional solution, which seems unlikely at this point. But if you could just walk folks through a little bit of your thinking as it relates to the debt ceiling debacle.
So this is, the way I think about this is the US's way of controlling expenditure. There is near bipartisan support for the statement that, if you ask Americans, is the national debt too high or too low, they'll, almost unanimously say the debt is too high and we need to curb the deficit and cut expenses. But in the next question, if you ask them, what do you think should be done to expenses for Social Security, Medicare, and the armed forces, they will all say we need to increase them immediately. And there you go. That's 2/3 of the U.S. budget. So the debt ceiling is one of the legislative mechanisms that the U.S. political system has to curtail spending. I think my expectation, and I understand financial market participants' expectation, is that there will be a curtailment to the deficit that will lead to an increase in the debt ceiling. I don't think anyone expects or wants a default. It seems to me that this is a political tug of war between the Democrat administration and Republican held House of Representatives that will be resolved one way or another. My expectation would be that it will be resolved probably toward more deficit cutting and end up with some repercussions for the economy, but nothing like a catastrophic default. There's a lot of people contemplating what would happen in a catastrophic default, to what extent the Treasury is being very truthful about June 1st being the important date. Again, I think the performative aspect of the debt ceiling is more important than the technical aspect, and it's a way to force down expenditure. I wouldn't expect a default in the United States federal debt.
Dimitris, the last time we came this close to the precipice on a debt default, there was a shift in the ratings of U.S. denominated government debt. Do you foresee any such implications this time around, as we inch closer and it doesn't seem like there's any progress being made?
I think it's really interesting because I went back to see that S&P decision on downgrading U.S. debt, and it actually, the concern wasn't that, we came so close to the precipice, therefore, it shouldn't be AAA, it should be AA-. The concern was the plan in place is not a credible plan to reduce the U.S. deficit over the long run. And so it's a very different type of consideration. I don't expect we'll see something similar this time. Again, you can't rule it out because, credit rating agencies have their own internal processes and responsibilities to report on such risks. But debt to GDP has been going down over the past 2 years. And this is one of the silver linings in the inflationary bout that we've had, that US debt to GDP, which, as with many countries, increased dramatically during the COVID crisis, has actually been declining over the past couple of years. And I think that's, probably a better picture for US debt sustainability than commonly assumed.
Excellent. A couple of questions here, and we are approaching 10 minutes before the top of the hour. So we'll try to squeeze these three in and then wrap with a little bit of a conclusion. But I really appreciate everybody's engagement with the subject matter here. And Dimitris, the ease with which you're able to respond to some of these both technical and timely and important questions. We got a question here about commercial real estate, which you alluded to a little bit earlier in the conversation. The questions around rising vacancy rates, and as you suggested, the shift to remote work, and frankly, the ways in which commercial real estate loans are syndicated, but also the ways in which buildings are financed. We talked earlier this week about a couple of large investment companies walking away from assets in Los Angeles, for instance, and claiming bankruptcy. That was all firewalled, but do we see this as being problematic and potentially another shoe to drop in terms of rising risk to the banking sector?
I think that's a great question. I think it's a very problematic sector because it's not just a liquidity issue, right? This is a fundamental secular trend away from a need for offices that is affecting the future cash flows that will come out of these assets. And anyone sitting on these assets should be wondering, what are they actually worth given the new growth trajectory and given the most likely occupancy and price patterns. But I would say, given the overall set of problems that the US banking sector is facing today, that is probably a rather small aspect. We thought this would be the Achilles heel. I think in reality, it's a very small part.
Thank you, Dim. We've got a question here about the factors that would interfere with or impede an enterprising family reacting to some of these external risks in a timely manner. You did allude to the fact that at SVB, the chief risk officer position went unfilled for nearly a year. And there are obviously clear analogs there that you do need somebody to own risk management within the enterprise in some way. And that's one way of elevating the visibility of these conversations and the tracking of these risks. But any thoughts on how to help enterprising families to keep an eye to the horizon, out the window, into the world a little better?
Of course. I mean, I have many thoughts, and in fact, we have a LGA risk management solution that I'm sure Devin will be very happy to sell you. But more broadly thinking, is there a chief risk officer, formally or informally, within the enterprising family, a person responsible for risks, responsible for thinking and communicating these issues? Are they communicating to all the members of the family where these risks lie? I think that's also incredibly important. And another problem, key vulnerability that I think exists is sometimes, especially with entrepreneurial families that generated the wealth, the relationship with the banker can be very close and can be very emotional. I mean, these are people who have supported the enterprise over multiple iterations of growth, and I'm sure in many cases tougher, help them get through tougher times. So it can be very emotional, and there's a mismatch there between the best interests of the enterprise and what families is their responsibility toward an important business partnership. So I would look at that as a key area of focus to make some clear-eyed decisions.
Excellent. Just to build on that you can always begin, families can always begin with better risk awareness, but it's translating that into risk intelligence. How do you integrate the information that is out there in the world? How do you distill the signal from the noise and find ways of turning it into more practical and pragmatic ways of making better decisions internally? We like to believe that, and have seen this manifest among clients, that having a comprehensive family enterprise risk management framework and system in place where you're tracking risks, you're prioritizing them, you're managing and mitigating them effectively. They've been assigned a sponsor, so to speak, somebody who's responsible and accountable for taking care of them, and that you continue to stress test and revisit that it's not just a book of risk that sits on the shelf, but it's a living, breathing part of an organization. A risk intelligent organization is something that we believe in truly is supportive of continuity in enterprising families. I want to end with one final question here that came in through the chat or the Q&A module, and it's about the considerations of these events for companies' debt levels. And Dim, you and I have talked about this and wondered about it together, because companies, family companies in particular, are often conservative about debt levels, depending on the industries, of course, but those that do have debt levels, whether a debt on the books, whether it's variable or fixed, when it's coming due, is there any guidance you can give to folks who have borrowed or who have outstanding debt in this moment about how they can think about rolling or fixing or hedging or paying down debt in this moment?
Yeah, I think it's not so much a question, Devin. I think that's a great question. It's not so much a question of more debt or less debt, higher debt levels or lower debt levels. This will depend on a variety of factors, including tax exposure, tax shield that comes with debt, to what extent projects are self-financed or financed out of the common organization. But it's more about attentive debt and asset management. Being aware, we have entered a period of very high volatility, both in interest rates and inflation, and in financial markets. And being attentive, being aware that debt coming due in, say, 6 months or a year or 2 years might have to be refinanced at a much higher rate. And at the same time, being aware of the opportunities. When rates are extraordinarily low, might be a good time to borrow and keep the cash aside for more productive opportunities. So it doesn't just cut one way. I think it cuts both ways. And being attentive to what's happening in the world, what's happening with interest rates, what's happening with the financial system, can turn into a major advantage, especially for, as our question noted, very well capitalized family enterprises that can take advantage of these moments.
Fantastic. Thank you, Dimitris. And let's bring our session to a close here today. Obviously, we could go on for quite some time. This is a rich vein that we want to tap further, and are happy to have these conversations with families and their trusted advisors who are wrestling with some of these issues, or just trying to track and understand and contextualize what's happening in the world around them. But do very much appreciate everybody who joined us today for our inaugural LGA Insights event. I also want to remind everybody that the best way to manage through a crisis is, in fact, to be well prepared heading into that crisis. So you often want to do that before a crisis begins, or as Ben Franklin once remarked, those who fail to prepare are preparing to fail. So we hope that in some small way this webinar has been helpful in helping you prepare for the uncertainty and change that is likely in the weeks and months to come. If you'd like to learn more about any of the services Dimitris just alluded to and showed on screen, of course, we would be happy to discuss. And on behalf of Dimitris and the whole LGA team, I want to thank you again for joining us. And we look forward to seeing you again on the next LGA Insights webinar. Really appreciate you joining us, everybody. And Dimitris, great job. Thanks so much.
Thank you very much. Have a good day.
Have a great day, everybody.